Welcome to Finademy course of income tax and how to lower it. Our topic today is 401k plans. Use the link in the description to download the app on the App Store for more courses and free practice tests. Number 1. A 401k plan is a tax-advantaged, defined contribution retirement account offered by many employers to their employees. It is named after a section of the U.S. Internal Revenue Code. Workers can make contributions to their 401k accounts through automatic payroll withholding, and their employers can match some or all of those contributions. The investment earnings in a traditional 401k plan are not taxed until the employee withdraws that money, typically after retirement. In a Roth 401k plan, withdrawals can be tax-free. There are two basic types of 401k accounts: traditional 401k and Roth 401k, sometimes referred to as a designated Roth account. The two are similar in many respects, but they are taxed in different ways. A worker can have either type of account or both types. Answer the question. Which of the following is not true about the 401k plan? A 401k plan is a defined contribution retirement account offered by employers to their employees. B. A worker cannot have both traditional 401k and Roth 401k. C. In a Roth 401k plan, withdrawals can be tax-free. D. 401k plan is named after a section of the U.S. Internal Revenue Code. The correct answer is B. A worker cannot have both traditional 401k and Roth 401k. Number 2. When 401k plans first became available in 1978, companies and their employees had just one choice: the traditional 401k. Then, in 2006, Roth 401k arrived. Roths are named for former U.S. Senator William Roth of Delaware, the primary sponsor of the 1997 legislation that made the Roth IRA possible. While Roth 401k were a little slow to catch on, many employers now offer them. So the first decision employees often have to make is between Roth and traditional. As a general rule, employees who expect to be in a lower marginal tax bracket after they retire might want to opt for a traditional 401k and take advantage of the immediate tax break. On the other hand, employees who expect to be in a higher bracket might opt for the Roth so that they can avoid taxes later. For example, a Roth might be the right choice for a younger worker whose salary is relatively low now, but likely to rise substantially over time. Also important, especially if the Roth has years to grow, is that there is no tax on withdrawals, which means that all the money the contributions earn over decades of being in the account is also not taxed. Answer the question. For whom is the traditional 401k suitable? A. Employees who expect to be in a lower marginal tax bracket after they retire. B. Employees who expect to be in a higher marginal tax bracket after they retire. C. Employees who are covering the cost of childbirth or adoption expenses, up to $5,000. D. Employees whose outside income is higher than the salary agreed in the employment contract. The correct answer is A. Employees who expect to be in a lower marginal tax bracket after they retire. Number 3. A 401k is what's known as a defined contribution plan. The employee and employer can make contributions to the account up to the dollar limit set by the Internal Revenue Service (IRS). By contrast, traditional pensions, not to be confused with traditional 401k, are referred to as defined benefit plans. The employer is responsible for providing a specific amount of money to the employee upon retirement. Employees are also responsible for choosing the specific investments within their 401k accounts from the selection their employer offers. Those offerings typically include an assortment of stock and bond mutual funds as well as target date funds that hold a mixture of stocks and bonds appropriate in terms of risk for when that person expects to retire. They may also include guaranteed investment contracts (GICs) issued by insurance companies and sometimes the employer's own stock. Answer the question. Who can make contributions to a 401k account? A. The employees. B. The employer. C. Insurance companies. D. Both the employees and the employer. The correct answer is D. Both the employees and the employer. To learn the full course, please download our free app Finademy on the App Store. Thanks for watching. Don't forget to like, share and subscribe to our channel for updated videos every week.